Keith, thanks for your time today. We always appreciate it. Look, there have been market accidents in the past. We don't know whether this will turn out to be something that's more systemic or just something that is related to a single fund. But do investors need to take on board the lesson here that financial stability is important, and they need to think about that when they're thinking about their portfolios?
Well, I think it factors in, certainly, and I think what's happening right now reinforces that point. What I'd be quick to say though that what I feel good about is certainly in the U.S. With the financial system here, whether it's the large banks or others, I think they're extremely well capitalized right now, have a lot bigger cushion against events like this. But it does reinforce there's risk out there. You've got to know the firms you're dealing with. You have to understand the leverage that they're utilizing to do their business strategy. And we're now seeing the downside of a firm that obviously had problems in that regard.
Keith, the mania that we saw for meme stocks, et cetera, the Reddit crowd, that was all sort of blamed on day traders, guys who got stimmy checks and then put it back into the market. This, though, and this margin call says that maybe that wasn't the case. Maybe there was broader buying from bigger players instead. And I wanted to get sort of your read on that.
Yeah, it's hard to sort through. We obviously spent a lot of time understanding the dynamic, from the individual traders and individual investors standpoint, given our client base. But to your point, it's hard to really get visibility into how far and how wide and how are people trying to play that. The volatility remains. A lot of people thought it'd be a couple of week flurry and then, that'd be that. But obviously we're seeing that's not the case. So we may find out there were more institutions that were, or institutional investors that were playing in that space as well. And they're equally vulnerable depending on which side of the trade they were on.
Let's move on and talk about the bigger picture here and try and figure out what is going on, Keith. We're going to see the president unveiling an infrastructure plan later on this week, Wednesday. We'll talk about it Thursday, I'm sure, a great deal. We've also got a vaccination program that is moving on very aggressively in the United States, less so over here in Europe. 2021 is going to be an amazing year for the U.S. economy. The numbers are just going to be absolutely blistering. My question to you is, when do I need to start preparing for 2022 and 2023 when that monetary and that fiscal stimulus is starting to fade?
Yeah, it's an interesting question because you're right. I mean, we subscribe to your point exactly. We just, in fact, our Bank of America global research team just increased their estimate for this year's real GDP to 7%. And then that will include in the second quarter, we think, a 10% real GDP number, which is just remarkable. And then we have 5.5% for next year. But I think that's one of the things that, the capital markets are trying to figure out, right? There's three dynamics at play. Number one, it's in the immediate term, it's the rising of long-term yields, which we're now seeing, right? 10 years approaching 170 basis points, high 160s. The second thing, and this is exactly to what you're asking, which is what is the terminal growth rate of the economy? Because we're going to be in a bit of a sugar high here, given all the stimulus, both fiscal and monetary. But then when that all sorts out, where do we land? We think for 22, it's still a good story, 5.5%. And then the third piece of that puzzle is inflation. And the capital markets have to sort through kind of all the above and then decide what's the right track for the markets. So far, that answer has been higher because part of what's happening too with this stronger than expected economic growth is you're having a faster healing of the labor markets. So we now think that, this year, by the summer, unemployment can go down to 4.7%, 4.5% by the end of the year. And by the summer of next year, we could be back to full employment. We could see a 3 handle on unemployment. So, it's all a ripple. And then the last thing you see coming in, which is a positive, is the earnings. And right now we're looking at, I think consensus this year is still about 172. We think you could see 180 plus potentially this year with, next year, 2022 being $200 plus. So there's a lot of positive underpinnings, not just to the economy, but to the markets.
Yeah.
But as you said, we got to keep looking forward.
But Keith, I have to wonder, that also begs the question, what are people going to spend their money on? Because it's all predicated on, in essence, money coming out of the government into people's pockets and then what they actually wind up buying. We showed a chart earlier that showed the households that got stimulus payments, how much they spent year on year versus those that didn't. Where
Yes.
are they spending, and is that sufficiently priced in?
I don't think it's sufficiently priced in yet. I mean, we're seeing a tremendous surge, as you suggest. We look at numbers. We have a great look into the U.S. Economy because of the number of customers we have at Bank of America. And our research team does a great job of aggregating the Bank of America credit card and debit card data. So if you look over 2 years, because you're starting to get now we're seeing the turn down the economy showing up. So the 1 year numbers are off the charts, 45% year over year. 23% over 2 years, so going back into 19. But what we're seeing is spending kind of everywhere. You're seeing definitely a pickup in restaurants, travel, leisure. That's where a lot of the pent-up demand is, because people couldn't go out and spend the money there. So we think it's going to be across the board, but particularly in travel, leisure, lodging. Right now, the U.S. consumer has $4 trillion of savings, of which about $3 trillion is excess savings. And if you look at the consumer spending, nominal consumer spending is about $14.5 trillion. So you got almost 30% of spending still in the form of savings, right? So as you start to unleash that, and look, all $3 trillion will not be spent. Some will be saved, some will be invested, the rest will be spent. The big question is what's the percentage breakdown there? But no matter what it is, the number is so big, we think you're going to see spending across the board, and especially the catch up. We've seen a big jump in restaurant spending lately in our card data, as well as travel picking up and hard goods, furniture, and things of that nature as well.